Today on the Wealth Transfer Podcast, we have Bob Bridges, the principal at Value Incorporated. He does business valuations every day. He's got a wealth of experience, no pun intended, around helping businesses valuate their businesses, whether it's for estate valuations or for transfer or some other need to know what the business valuation is. So I'm excited to hear from Bob today. I've been wanting to know for months more about how businesses are evaluated, especially when we think about it from a wealth planning and estate planning perspective. So Bob, tell us what you do every day. What do you guys do in helping businesses evaluate their businesses, and what's the purpose of it?
Yeah, good question, Matt. We do a lot. So we work on over 200 projects a year. We're a small boutique firm, probably 12 people. And, day to day, if I'm just doing the work myself, the valuation, I'm going to be analyzing the historical financial statements, projecting cash flow forecast, pulling comparable companies, analyzing the balance sheet to make sure we captured all the assets and all the liabilities. And a lot of it at this point in my career is managing these projects and have the analysts help me out. Let's pull comps for these, what industry they're in. Sometimes they don't have a specific industry. So if it's a good example back in the day is like Soft Warehouse back in the 80s. So it was a software company, but all the software companies that are publicly traded, they're the ones that create the software. And then you have retailers that sell, like Home Depot, that sell garden utensils. So it's like, where do they fit in that? They're somewhere in between. So we're always trying to tell the story that the client's trying to purvey.
And I could probably think of a few reasons, but tell us, what are all the reasons someone would need a valuation of their business?
Good question. So a lot of what we're described is Bob does math for attorneys. So it's when you need an opinion of value. Sometimes we'll have clients that come up and say, well, I want to sell my business. I want an idea of what it's worth. And that's fine. We definitely do that work all the time, but normally that's in a planning structure because you want to do the planning before you sell. If it's gift and estate, you want to get the assets moved around and allocated before you do a transaction. Other times it's, they want to sell now. Okay, well, I can tell you what, somebody might pay for it, but ultimately you're going to be finding a business broker to find that one right deal that's going to be best for the company and the best for you and your family. And so oftentimes I'm like, well, I can tell you what it's worth, but if that's all you're really looking for, it may be best to not pay the money with me. Let's just go straight to a business broker and talk to some of those guys and see what they think.
And when you think about those 200 clients, would you say the majority of them were thinking about selling, or was it actually from a planning perspective?
Yeah, so most of it, when it's from a planning perspective, it'll be, well, we're going to be selling the company in a couple of years. So we want to effectively be able to move this wealth to our children and grandchildren without creating a wealth tax burden. With that, there's kind of different levels of value. So like if you're selling your house, it's what's somebody going to pay for this? And then you get a good realtor and have them market the home for you and try to get the best deal you can. But whenever you're talking about a company, there's different levels of value. So, kind of what we're talking about now is what the company would sell for, and that's financial control value, what somebody's going to pay to have financial control over the employees and the contracts and the future cash flows of the company. That's known as the financial control value. Below that is also a very common one that's normally people don't recognize, but it's on a marketable minority interest basis. So if I was buying or selling shares of Google or Tesla or something like that, my vote on my single share that I just purchased isn't going to have really any effect on the governance of the company. I can't buy 100 shares of Google and throw my weight around, but it's publicly traded. I can get in and out of it easy. So that's known as marketable minority interest value. For private companies, you take a discount for lack of control on top of that, and that's what's known as a non-marketable minority interest. And so that's the level that you want to give to your children at, because that can be discounted over 40%, depending on the facts and circumstances. So you're gifting that and then saving yourself taxes, and then you go through a transaction later where everybody cashes out. It's one level that I left off of that, though. There's also what's called a synergistic value, and this is important to understand. The synergistic value is whenever you find that one perfect buyer, that say that you have a company that develops some technology and for a certain company, and there's a competitor of yours that says, I want that customer as a client, so I'm going to pay out the nose for this company. So that's up and above the fair market value standard. But the first three that I mentioned, those are the levels that we talk about whenever we're doing valuations for the IRS or tax court, things like that, because that's a hypothetical buyer, hypothetical seller.
That's awesome. I actually had never heard those. I mean, I've heard of the idea of marketable or non-marketable interests, but I love the thinking about it as levels. So are you starting with the financial control level as the kind of the main value and then discounting off of that? Is that generally how, when somebody needs a non-marketable minority interest valuation, you're starting with something like what the market value is at financial control?
Absolutely. That's typically where you start. There's some industries where you have a lot of public comparables. And if you're using price multiples off of those, you're going to start out with a marketable minority interest. So you only get the discount for lack of marketability after that. But generally, if you're building cash flow models, you're building it on financial control value and then applying discount for lack of control and discount for lack of marketability for a minority interest in a private company.
So it seems like sometimes you have clients that you're working at the same time and they want different things from you. Like one wants you to tell them that their company's not worth very much, and another one wants you to tell you that their company can sell for a lot more than what it's actually worth. Right? Are you dealing with both those competing situations?
Yeah, sometimes you do. So, a good example is, say somebody's about to, as a signed letter of intent, and they want to give part of their company to a charity, donor advised fund. So we do those all the time, and so they're wanting the highest value possible for that gift. Other times, it's estate planning, so they want a lower value, and it's not that we can make up numbers and just come up with a ridiculously low value. We have to be able to be supportable, but we can, tell the story that, this company requires a lot of working capital, or it needs to expand their warehouses or something like that, where a lot of capital expenditures coming up, which will probably be handled, before they want to sell the company. So we factor all those things in. But what we'll typically do, though, is we will, in situations like that, where it's just for the owners and estate planning, is we'll be engaged by the estate planning attorneys directly, because attorneys have attorney-client privilege with their clients. We don't share that. We're independent, so we don't have any attorney-client privilege. So by engaging the attorney, if we come out with anytime you have a value, there's a range of values, right? So if you ask clients about Tesla, you're going to say, okay, well, half of them think Tesla's going to be worth trillions and trillions of dollars, and the other half are short it. They think it's going to zero. So there's a range of values depending on what story you're telling. So whenever we work with the estate planning attorneys, we try to be on a reasonable end, but on the lower end of it, something that we can support that tells the story. All the multiples match up with what story we're telling and all that. But we don't want a synergistic buyer to be able to see that. So the attorneys have that attorney-client privilege. So whenever they go to sell the company, if the buyer says, hey, I want to see any valuations you've had done at the company, they can say, well, we haven't had any done, because it was their attorney that had them done.
That's a really neat strategy. I hadn't even thought about that. That's a great idea. Now, when somebody's thinking about hiring you to do a valuation, and it's specifically for wealth planning, what are some of the mistakes you see them make and maybe it's just mistakes they can still solve because it's all planning at that point. But what are some of and I'm going to ask you the same question, but on the flip side, when somebody's preparing to sell their business and they're asking you to do evaluation, what are the mistakes they make? But on the wealth planning side, when they come to you, what are some things that you wish people would do in advance, or that they could solve, or mistakes that they could avoid before they hire you?
Yeah. And yeah, those come from a lot of different directions. And oftentimes it's something simple. If you have a family limited partnership where you're trying to protect assets from maybe that you just saved up over your lifetime, or maybe you inherited or whatever, and you've got a lot of money in this family limited partnership that's designed to be passed on. If that partnership is paying out money like a cash register, then it makes it hard for me to say, well, this client may never receive any money out of it, but they pay out every year. It makes it a tough story to tell. So you want to treat it like anytime you have a partnership like that, even if it just has publicly traded stocks in it that's managed by your wealth advisor, you want it to be, treated like a business. So oftentimes whenever you see people get in trouble is with the IRS, is they have they set up an entity and they're not treating it like a business.
That's a great point. Now let's think about it from the, not just from the estate planning side, but even from the, I've come to you and I want to get a valuation on my business because I am thinking about planning to sell. What are the mistakes you see, or what are the things you see that clients could deal with ahead of time that would make it easier for you, or that would make it better on them when they're looking to sell their business?
Yeah, so a lot of it's having good management in place. So if you sell the business, obviously you want to get out as soon as possible. And typically people will, expect that, okay, I'm going to work there part-time for a couple of years, make sure there's a smooth transition. That's not uncommon. But, having that management in place, that's a huge portion of value of the company. Employees, that's something we actually quantify from time to time. What's the value of the employees? And kind of a rule of thumb you can look at for a lot of companies, what payroll you're paying out, the employees are worth 20% of the annual payroll, including benefits and all that. So that's because if you think about, if we had to start from fresh, how much would it cost to go out and hire and interview and try to recruit people? And then we have to train them. We have to get them up to speed and teach them how we do things. So that takes time and money. But also one of the other mistakes that we see, because we do a lot of litigation as well. So in mergers and acquisitions, we do a lot of work whenever activity's high on deals going through. Whenever the economy turns down, we're doing a lot of work on deals that fell apart. So people have earnouts and things like that. We had a client not too long ago that signed an agreement and said, okay, well, I'm going to get X percentage of the profits after the deal's closed. And they said, well, we're going to merge you in with this other company that's doing about the same amount of revenue, but they were losing money. So he didn't get hardly any earnout out of it because they didn't do their homework ahead of time.
That's fascinating. And, I'd love to hear, I know that you and your company are used as experts on a number of court cases. And do you have any interesting scenarios or court cases that you could share that you've been involved in or done some expert testimony on that would be interesting just in general?
Yeah, I can think of a couple of IRS cases that we had over the past couple of years. So one of them was Kiefer. And the problem with Kiefer is they had a partnership that held real estate. And anyway, so they said, well, we're going to sell the real estate, but we have this huge tax gain, so we're going to gift a portion of the partnership to a donor advised fund, which is done all the time. So the analysts that they hired did put forth their opinion on the value, and they wrote it off in their taxes. And then whenever they decided to sell the company, they said, oh, no, that was only for 10% of the real estate. So I don't know if they were, they had some conflicting plans or something like that, where maybe they wanted to do a 1031 exchange with the property or something. But that deal blew up. And a lot of the problem was, you didn't have the advisors either weren't communicating effectively, because somebody needed to raise their hand and say, hey, this is a problem, before the IRS flagged it.
So what ended up happening in that case?
Oh, they ended up giving the money to the charity, and the court ruled that no, you're not getting a write-off on that gift because that wasn't what you were doing. So they basically gave them donor advised fund a bunch of money without being able to write it off for their taxes.
Gosh, that stinks, man.
Yeah, I was going to say another one we worked on with the IRS was in the case of Fields, and that was an interesting case because you had a guy that was taking care of his aunt and helping handle all the money and all that, and she didn't have any children to give it to, so it was going to go to the nieces and nephews. So this guy had power of attorney. They set up a family limited partnership pretty much close to when she was dying, but he set himself up as general partner as well, even though he had power of attorney. So the court ruled that, because you have power of attorney, then she's still literally in control of the assets. So she didn't get the discounts for lack of control, lack of marketability on her portfolio that could have happened if it was set up different. And again, somebody just needed to raise their hand early and say, hey, there's a problem here.
Well, and so I guess in that situation, was it the fact that he had power of attorney, or that he was acting as the power of attorney? Like, was the fact that he had power of attorney meaning that he was able to act as her, so she did have control, or was it that he utilized it in different capacities?
Yeah, so he had durable power of attorney, so he was actually able to set up the partnership for her and set up the general partner for himself as general partner. And so he had full control over everything, but he had a fiduciary duty to act in her best interest.
Yeah, that's tough.
And acting in her best interest, he can't take a haircut of 35% on her assets.
Got it. Yeah. So what should, and I know you're not an attorney, but what should he have done differently if he wanted to actually help her have a discount on those assets?
Well, first thing is they should have done this a long time ago. That would have helped. So planning early is very important because anytime there's a transaction, within months of somebody passing away, the IRS is always going to raise their eyebrow and say, well, what's going on here? This is just a tax play. It needs to have a reasonable business, some type of business reason for it.
So in succession planning, and I know that oftentimes, the main goal is either to get those things out of the estate. I mean, obviously a family limited partnership, the goal is to have them in another family member's name, but they don't have the control. So what is the recommendation from a succession perspective to whether it's gifting stock or whether it's getting control out of the main, like what are you seeing? And obviously, again, you're not an attorney, but you see this all the time. What are you recommending so that people can actually get those discounts and have assets that are maybe outside of their estate?
Yeah, a couple of different things. So if you have, let's say you set up a family limited partnership, the general partner owns 1% and can't be removed, and then you've given 20% to your heirs. Well, the remainder of that, the remaining 79% plus the 1% is still in your estate. So you're not going to get any discounts on that because you still control the 79%. So sometimes it's as easy as you can either gift the rest of it and stay in control of it. So you can gift away all the limited partnership interests and still own the general partner and maintain control, but you're maintaining control over something that you don't own anymore.
Perfect.
So then the general partner is just going to be in your estate, and there's obviously no discounts on a general partner interest that can't be removed. On the flip side, we had a construction company, and this guy, he had run it forever, started it and had a guy that was completely running it, and he really didn't do anything with it anymore. So he needed to get control out of his estate. So the simple thing there was give the general partner interest to the guy that's running it now. Let him control it. You trust him. You don't even check in on him hardly ever. So give him that. So that way your family can receive discounts on those interests.
Now, how do you determine what the level of discount is, or how like if somebody's thinking about these things, what are some just rules of thumb for determining what kind of discounts they might be able to get?
Yeah. So there are multiple discounts. So if you put a 20% of your company into a family limited partnership, then that's going to have a discount for lack of marketability. Also, you can take because it's now in this partnership wrapper, and getting back to the levels of value, think about a closed-end mutual fund, right? So it's a pool of publicly traded stocks, and stocks trade theoretically with a discount for lack of control. And within that, those trade at discounts to net asset value. So sometimes if it's a poor manager, they're going to trade at steep discounts. Other times, if you're like Gabelli, they may trade at a premium because Gabelli's a well-known manager. But so within that, you put that into the family limited partnership, and then that's family limited partnerships treated as a entity like a closed-end fund that holds all these securities that are already discounted. So then you can take an additional discount off of that. The one thing you can't do is say the company is private, so we're going to take a discount for lack of marketability there, and then take the same discount again in the partnership. That'd be double dipping. So you kind of want to think about it as like a switchboard. And, have we taken this discount? Check. Have we taken this discount? Check. So you can't, once something's not marketable, you can't make it any less marketable.
That makes sense. So let's talk about trust for a second, whether somebody's putting something into irrevocable trust or a Q-tip or a remainder trust or different things like that. What are you seeing, or how does that change how you might get a discount, or how does that change in transfer of business ownership?
Yeah, so whenever it goes into trust, it's going to be discounted going into the trust whenever the gift's made. But generally, like if it's a living trust that you have it in, there's no discounts on that because it's your living revocable trust.
Right. Bring it back. It's still in your estate. Yeah. So in the living trust, obviously in the revocable trust, it's still in the estate. So there might be you need a discount at the later, I guess, or if you're doing something with a FLP or whatnot. But if they're outside the estate in one of those other trusts, then you're getting the discount at the time you put it in the trust.
Right. Yeah. And one of the popular things people are doing right now is putting them into slats. So you'll put a bunch of assets into family limited partnership. I own 49.5%. My wife owns 49.5%. I give my half to her, and then a year later, she gives her half to me. and then they're outside of the estate. We can enjoy the income from them during our lifetimes, but then the kids, the beneficiaries, the remaining beneficiaries, the children, whoever, they're going to get the assets at the end.
So just for the audience's sake, give us some definitions, define the terms, and tell us a little bit more about how that works.
Yeah, so a SLAT, it's a spousal lifetime access trust, which basically lets me take my assets and put them into this SLAT, and then my wife can use the income from those assets during her lifetime. But whenever she passes away, those assets pass to my children.
So it's sort of like a similar sort of either remainder trust or Q-tip kind of it's its own version of something where I've got the lifetime enjoyment or usage of this, but it's already outside of my personal estate.
Exactly.
Now, have you had any casework that you've had to do in those sorts of trusts?
No, the SLATs are fairly new. We just finished working on one in Seattle for the IRS, it started with a case called McDougal, if anybody's following that. But Lewis, the daughter and the son, they were wanting to get this irrevocable trust unwound, and the IRS didn't like the way it was done, so it ended up being a mess for tax court. So they're trying to figure that out, and we'll see how that comes out in the next couple of months.
Did you work on the McDougal case?
Yes.
And what were some of the other facts, or are you able to share some of the facts of that one?
Yeah, I mean that's what it is. It's so when the matriarch died and the husband's still living, she put her share of these huge companies, real estate companies, into a irrevocable trust. Well, under Washington law, they were allowed to break the trust. So they break the trust, and then there's an income beneficiary, which was the husband. So you have to determine what his value is, and then determine what the value is of the remainder interest, which is supposed to go to the kids. So it was a fight about, what's that income interest versus the remainder interest worth.
That's fascinating stuff. Now, what other recommendations would you give to someone who has a business where the majority of their wealth is tied up in their business? Is there anything else you'd recommend as someone who sees a lot of these valuations or deals with clients in this realm a lot? What sorts of steps or recommendations or even just general advice would you give to someone who owns a business and needs to be thinking about these things?
Yeah, so a lot of it is putting together a team. Generally, kind of the foundation of the team is your financial advisor. You're going to have an estate planning attorney, and you're going to have a CPA. So those are kind of the core of your team that are going to know all the ins and outs of, your family and where they are. Somebody like me, for instance, I'm not part of that team. I'm a tool to be used by that team. So whenever they're going through the process, like an attorney emailed me yesterday that's putting together a document for family limited partnership and asked for my thoughts on it. So I'm like, okay, well, this is good. You might look at this if the family's wanting to do it this way. So just, other things that I've seen, because I see so many of those over time. I mean, I literally see probably 50 of them a year easily.
Well, that's interesting. I mean, I want to pick on that for just a second. What are some of the things, and maybe obviously you don't have anything written down, but just off the top of your head, what are some of the things you see in family limited partnerships that you say make a great one? And what are some of the things you see that maybe end up becoming problems?
Yeah, the main idea is that it's supposed to be very restrictive. So you want high restrictions on liquidation. You want high restrictions on being able to remove the general partner. Sometimes you want to make it so that way you can flip control if you wanted to. So say if we had one case that was interesting, and this was on appeals where there was a poor job of evaluation done and they had like a 20% discount or something like that. The IRS says, we can't rely on this, so we're just saying no discounts. Well, we came in on appeals, and basically the decedent, well, to back up a little bit, the decedent would have been, whenever he sells his interest, the remaining partners have to say it's okay for them to be a substitute limited partner. So anytime you sell an interest, it's for a non-voting interest until you're voted in to be a partner. So we actually went back to the IRS during appeals and said no, this is full boat discounts. So we don't need to water this down any. And the attorney's like, no, let's just meet them in the middle. This is the right number. So they ended up getting a higher discount after going to appeals on this, because we're able to show that because whenever the decedent died and the way the partnership was structured, the remaining limited partner actually is the one that had control of the daughter. So she could remove the general partner with just a wave of a pen. So sometimes you can think through and think, okay, well, how many children are there? What does it take to remove the general partner? And, and just kind of map that out. And nobody knows exactly what's going to happen in the future, but, you good estate planning attorneys can plan for that type of stuff.
That's awesome.
Yeah, because in addition to that, it's sometimes if you're below the estate tax threshold, you don't want any discounts because you want to step up in basis.
Well, exactly. So if you're not, so I wonder. I mean, that's something I often think about. If somebody's either on the borderline or if they maybe are not yet above the threshold, it's kind of like you got to plan for. Am I trying to make my estate too complicated that it's going to hurt me or hurt my kids, or am I making it where I expect it to grow in a certain value or go to a certain point where I need to be planning for being above the 30 million or whatever the number is as it grows with inflation.
Exactly. And that's where estate planning attorneys will look like, say, okay, well, this business has a lot of growth potential. So we want to get this outside of the estate now so it'll grow. And if your company's growing at 15% a year, you're going to double it every 5 years. Even if you have a conservative stocks and bonds portfolio and it's growing at 10% a year, that's still going to double every 7 years. So get that outside of the estate, let it grow outside the estate. And my joke is always, well, you don't need to move it outside your estate if you don't think your returns are going to outpace inflation.
That's a great point. Now, Bob, any other either stories or anything other interesting that you want to share with the audience, just in general, anything I didn't touch on or something that maybe is fascinating to you or interesting to you, or another either case or story, any of those things that you want to share?
Not a lot, but I will say one thing. Trust your advisors. They're there to help you, especially like financial planners. It drives me crazy. I see people, whether they're Democrat or Republican, they're both going to cash before the election. And it's, what are you doing? Have a plan, stick to it. Because you see people all the time, they waste 10% because they decide they want to get out and then they're not ready to get back in at the right time. So it's, I see it all the time. I saw it when I was at Fidelity, and I still see it today.
And Bob, how can people get in touch with you or your company? Where's the best place to connect if they want to explore different services you offer?
Yeah, so we have a website. It's valueinc.com, valueinc.com, as in Value Incorporated. My contact information is over there. I'm always happy to talk shop, so people are welcome to call me whenever they like. That's not something that I sit and start the meter for billing meter on or anything like that. I just, I'm a tool for the team to utilize. So people call me all the time and ask questions, and that's how I like to help.
That's awesome. And we're based in North Texas, but I assume you work with a number. Obviously, you've got the McDougall case up in Washington, other places. Are you dealing with businesses all in all 50 states, or is there specific service areas that you generally work?
Yep, worked all across the U.S. I've done a couple of projects in Puerto Rico. We've done work for companies in Europe. So we work all over. Yeah, and most cases, I don't have to get on an airplane to go look at somebody's cash flows. So most cases, I can do it here at my desk. If I have to get on a flight, I'm 10 minutes from the airport.
That's it for today's episode of the Wealth Transfer Podcast. If you found value in this conversation, would you leave us a review? That would be just so honoring to us. We'd appreciate it. And if you know somebody who might need to listen to this because they're thinking about their next chapter, will you send them a link to this podcast or this video so that they can listen more as well? For more episodes and expert insights, be sure to follow and subscribe. That means the most to us. Follow and subscribe, please, please, please. And when you're ready to take action on your own real estate plan, or if you need help with wealth transfer planning, we know a number of experts in all the different spaces. We'd love to connect you with them. You can reach out to us via direct message or comment. You can email us, matt@templeton.realestate. No .com, just templeton.realestate. And I'd be happy to connect you with an advisor. Thanks so much.